At only a quarter of a point, the first cut may not be the deepest, but it marks a significant shift in a decade of US economic policy. The decision has been predicted for months.
Throughout 2018, we saw excellent numbers for GDP and jobs growth. We were kind of on a sugar high from tax cuts and spending increases. And in 2019, the data now says the economy is slowing down.
Unemployment in the US is at a 50-year low, and wages are rising, although slowly. But in the last week, second quarter GDP growth came in at 2.1%, the slowest quarterly growth in more than 2 years. So some economists feel this decision by the Fed is a preemptive move at a time of global uncertainty and trade tensions.
This move by the Fed is more than just following domestic economic data and reacting to it. Make no mistake that this is a cut, a stimulus for the global economy as much as it is for the US economy.
Over 3 years, starting in December 2015, the Fed raised rates 9 times. It was largely to try and even out the economy after emergency monetary policy measures and severe cuts it enacted during the 2008 financial crisis. This latest reduction moves the US in a different direction. But Fed Chairman Jerome Powell signaled there was no guarantee of more cuts to come.
Let me be clear. What I said was it's not the beginning of a long series of rate cuts. I didn't say it's just one or anything like that. What I said is when you think about rate cutting cycles, they go on for a long time, and the committee's not seeing that, not seeing us in that place.
That didn't go down well with US President Donald Trump. On Twitter, he said he wanted to see the beginning of a lengthy and aggressive rate-cutting cycle. As usual, he said, Powell let us down. Powell says the decision to cut was not down to political considerations, nor the need to assert the Federal Reserve's independence. But with President Trump hinting at firing the head of the Fed, there may be more cutting to come, whether Powell wants it or not. Nick Harper, TRT World, New York.
Well, let's get more on the story now with Matt Maley in Newton, Massachusetts. He's the Managing Director and Equity Strategist at the trading firm Miller Tabak. Welcome back to the program, Matt. Now, few were surprised by this 0.25 of a percentage point cut to interest rates, but I think there was a stronger reaction, wasn't there, to Jerome Powell's comments after the Fed's decision. Why were some investors a little disappointed by what he had to say?
It seemed to be because of two reasons. Number one, that he seemed to indicate that this could be a one and done type of situation, or that there's a high probability that it'll be a one and done situation, and that kind of took people back. But also too, just the way he presented himself, he just seemed very unsure. You hate to say that the performance is really that important for a central banker rather than a politician. But still, it's like as you begin to ask the questions. One of the people you just had on that last clip were talking about this is a cut for the entire world, and I agree with that. But the problem is, why? I mean, are things really a lot worse than people realize? And especially when you look at the action in the European banks, which has me particularly concerned. It just kind of gives you a little bit more of a. It seemed to me that maybe Mr. Powell was afraid to tell us the real reason why they're cutting interest rates at this time. When insurance rate cuts, people talked about them. Back in the middle of the 1990s, in 1995, it worked out very, very well, but that insurance rate cut didn't work very well at all in 2007. So that kind of spooked people a little bit. And even though the stock market started to bounce back today, it's starting to lose a lot of that morning gains, at least here in the U.S.
So what issues do you think are weighing on Jerome Powell's mind then?
Well, of course, we have the number one, the trade issue, and it does seem like we're hearing from both sides that it's going to be a prolonged situation. We're not going to have anything, any kind of major deal soon. It's something I've been calling for a long time because we're asking for things that China just isn't willing to give in on, whether it be intellectual property or verification, et cetera. But the one other thing that I think few people are talking about, and people should be a little bit more focused on, is the European banks. I mean, we saw the news recently on Deutsche Bank. They seem to be trying to do what they can and really making some serious cuts and to turn things around. But the divergence between what's going on in the U.S. stock, I'm sorry, in the European stock market, you look at the stocks 600 index for the broad stock market in Europe, it's up 17% since the December lows. However, the Stocks European Bank Index, that's flat. It's down. I'm sorry, it's down from its highs in April, so there's major divergences developed between them, which is very eerily similar to what we saw between the U.S. banks and the U.S. broad market in 2007. Now, I'm not calling for a major banking crisis or anything like that, but it just tells me that there's some problems there that a lot of people aren't focusing on that could come up to bite us if we're not careful.
Okay, now we know US President Donald Trump has been Jerome Powell's strongest critic, really, even after this cut, which many had expected. He seemed to imply that Jerome Powell could have cut them by even more. Can you just explain to us what the president's thinking is on this? Why has he been applying so much pressure on the Federal Reserve to cut interest rates?
Well, it's two things. Number one, this trade deal doesn't look like it's going to come together, so that's going to stymie U.S. growth just as we're heading into the U.S. election. That's number one. And number two, unlike other presidents, really, you're going back many decades. Every president has, in their first term, they've come on and they've put their fiscal policies, their fiscal plans in place so they would really kick in the second and third year of their administration. That way, the economy would be lifting up as they come in for re-election. Donald Trump did not do that. He did just the opposite. He front-end loaded everything. So the whole fiscal stimulus that we got, that's kind of already played itself out. So he's not going to get that extra kicker that previous presidents have gotten. So he needs something else, especially if he's not going to get a trade deal. So he needs the Federal Reserve to lower interest rates to stimulate the economy for political reasons rather than, I mean, if our economy is so good, why did he says we got the best economy ever, well, why would we need the Fed to stimulate more? I think it's because we're not going to get the fiscal stimulus that most presidents get in the second 2 years of their first administration.
Okay, now, Matt Maley, can I just sort of put something to you? Donald Trump has just tweeted in the last few minutes something about China. I'll just read what we have here. Now, he says, our representatives have just returned from China. We thought we had a deal with China 3 months ago, but sadly, China decided to renegotiate the deal prior to signing. More recently, China agreed to during the talks. The US will agreed to during the talks. Now, the US will start on September the 1st, putting a small additional tariff of 10% on the remaining $300 billion worth of goods and products coming from China into our country. So clearly, he's decided to escalate this trade war that he has with Beijing. What do you make of that? I guess we could have seen that coming, really, when he attacked China as these talks were happening in Shanghai.
Well, yes, and it goes to what we just talked about. Why does he feel the need to have the Fed cut interest rates more dramatically than they did? It's because he knows that he's not going to get the juice from the trade deal. The fact that he's stepping this up is a lot of people have been saying recently, it's like, okay, it's not great that we have these 10% tariffs, but if we increase them, it's going to be much worse. And as I looked out of the corner of my eye, I'm just looking at the chart on the S&P 500, and it's falling out of bed. And that's because, again, if we really rely on the Fed, they're not coming through with massive stimulus. They're only coming through with some stimulus. We don't have the fiscal stimulus we had a year ago, and the trade deal's not come through. That's going to be hard for the stock market to hold up in the face of that.
Sure will. Okay, we'll be looking into that as the days come. Thank you, Matt Maley, again for your time.